2000. What might happen to change this thinking? First, I just returned from a conference sponsored by the European Journalism Center. The conference was held in Brussels and in Frankfurt, where we met with senior EU, EC, and ECB officials. Let's move to the next slide. In the past few months, I've had traders voice frustration at trying to understand the various talking heads from the Eurozone. So I thought it might be good to just briefly go over who's doing what in Europe. The European Commission drafts the proposals for new European law, which it then presents to the European Parliament and the European Council. The European Commission is also responsible for implementing the decisions that are made. The Commission meets behind closed doors mostly each Wednesday, but could hold emergency meetings. The European Council is responsible for decision-making and passes the laws, usually jointly with the European Parliament. During a 6-month period, the European Council will normally hold 1 or 2 full summits. It is this European Council that's meeting this coming Thursday and Friday. The ECB, we all know, is in charge of monetary policy and has a sole mandate to keep inflation under control. That is close to 2%. Remember, there was a change in the wording in 2003 that adjusted this goal from keeping inflation under 2% to keeping it close to 2%. I do all this briefly because there are strongly held views at the EC, EU, and European Parliament that may be seen as at odds with the ECB. Let's look at the next slide. This shows the European Commission's fall forecast. I put in both their U.S. and EU forecasts, and note that the U.S. has, for 2011, has a 2.1% GDP forecast penciled in. After the announcement last week about the Bush tax cuts being extended, many U.S. economists have raised their estimates for 2011 growth by 0.5 or even a full percent. In fact, PIMCO announced last Thursday that they're raising their U.S. growth forecast for 2011 to 3 to 3.5% from 2 to 2.5%. We'll talk about this growth differential more later when we focus on the Euro FX rate. In any case, the U.S. is expected to outperform the Eurozone next year. Now, with the new stimulus from the tax cuts being extended, analysts see scope for even larger U.S. outperformance, and this is expected to help the dollar in the short term. Let's look at the slide. Like other central banks, not particularly worried about inflation right now, the ECB is also not particularly worried. But less, ECB members are always on the alert for signs of the inflation picture changing. And only last Friday, Trichet said that the price of oil and commodities is a permanent issue for all central banks in the world. On one side note, during meetings with ECB officials, and I need to stress that this was not a board member, one or less asked what the ECB thought of gold's sharp rise to lifetime highs recently. The official said that the ECB did not consider gold's price in their assessment. The officials we met with were mostly concentrating on the permanent crisis mechanism that will replace the expiring European Financial Stability Facility in mid-2013. And German Chancellor Merkel and France's President Sarkozy both said Friday that the primary task of this week's summit in Brussels will be to work on the draft of this measure. Today, Market News had a German government source tell us that, again, the main topics of the summit are going to be the adoption of the permanent crisis mechanism and any necessary EU duty changes. So do not expect any talk about an increase in the volume in the EFSF or a proposal to give the EFSF the right to buy government bonds at the peripherals, the source told us today. At my meetings in Brussels about a week and a half ago, EU officials made it clear they intended to give the Stability and Growth Pact more teeth and stressed they're working on plans for a peer review program. And this would be where all 16, and this will be soon to be 17 with Estonia joining the EU in January. So all 16 countries would be able to see each other's proposed budgets and would be able to make recommendations. Now, EC Commission President Barroso mentioned this peer review system back in May, so it's not new news, other than officials feel strongly that this mechanism will prevent countries from making unrealistic goals and then later suffering embarrassment that may affect other member countries. And later in Frankfurt, ECB officials that we spoke with were eager to talk about the new stress test. Some countries will be given the test as early as February, and the results will likely be made known over the summer. We did have one official mention that the stress test could come out in July. The new stress test will be larger in scope than the prior test, with a greater number of banks being scrutinized, and the parameters used to judge the health of the bank will be widened. The ECB official we spoke with made a point of stressing that the ECB is doing its duty by maintaining price stability, while at the same time they made it clear that Eurozone countries need to step up to the plate fiscally to allay market fears. ECB officials stressed that it's not their job to hold the market's hand when there are stresses in the financial market. And one official told me point blank, and I quote, "We are not responsible for financial stability." What struck me is that in Brussels, all the officials we met with were praising the mechanisms either already put in place or that would be in place shortly to address the future crisis. In Frankfurt, the ECB was making it clear that they were there to take care of inflation. That was their job description from ECB law. As an outsider, the problem to me seemed that no one in Europe seems to own the current problem of the peripheral widening. The EC, as my colleagues in Frankfurt have reported over the past month, there are varied views about the ECB stepping in to buy peripheral paper in the market. Some think it's needed that the ECB should be doing this in order to maintain price stability and therefore deal with their inflation mandate. Others think the ECB is overstepping its bounds. One senior official that I spoke with in Frankfurt seemed to think that the ECB had been tepid in their purchases, and he was glad that speculators in the market got their fingers burnt when the ECB stepped in on December 2nd. That was the ECB decision day. Nevertheless, the ECB is clear in their mandate, in their minds, that they are not the Fed, that the ECB has a different mandate. And the market needs to not expect the same kind of action from the ECB as the Fed. While the Fed continues to add liquidity to the market, ECB officials keep stressing that bond purchases being made to help the peripherals will be sterilized. Frankfurt asked another official if the ECB considered other tools to deal with the crisis, and if so, why they were discarded. He said there were good ideas everywhere in terms of what the other central banks, such as the Fed, were doing regarding implementing monetary policy. He said that QE2 wouldn't work for the ECB because of how the ECB sets up its financing. In the U.S., more corporations raise money on their own, whereas in the Eurozone, the central bank helps the funding by giving money to other banks to pass on to the corporates, he explained to me. The ECB is expected to step in more aggressively with their peripheral bond purchases next year, expected Eurozone issuance in 2011, and that brings us to the next slide. Poured over the 2011 FX outlooks line in my inbox, I was struck by the similarity of most forecasts. The analysts see the euro falling below 130 in Q1, and you find several forecasts in the 120 to 125 range for the end of March. And if you look at the mountain of Eurozone debt issuance expected for 2011, you see why the market is so bearish. Later year forecasts diverge, with some seeing the euro remaining low in the 120 to 125 range, and others looking for a rebound back over 140. The thinking for these higher forecasts is that if the peripherals can raise money uneventfully in the first half of 2011, the euro will react positively and may get a further boost from ECB rate hike expectations. The ECB is still expected to raise rates before the Fed, and today the German IFO said it expected the ECB to raise 25 basis points before the end of 2011. Also today, the BOA Merrill Lynch survey said a net 60% of those polls look for the Fed to be on hold until 2012, and that was up from 47% with that view in November. Let's now look at the Eurozone issuance estimates. Swiss estimates as of last week put the total for 2011 to be 689 billion euros, and they have a breakdown of 114 billion for the peripheral banks, 90 billion for the peripheral sovereigns, and 485 billion for the non-peripheral sovereigns. UBS put the total Eurozone issuance for next year 837 billion euros. All of these estimates will be ever-changing, and it's a good idea to keep tabs on upcoming issuance by looking at our main wire for the M&I European and UK government debt auction calendar, and then there's also an M&I Eurozone net cash flow matrix, which is the website, and the matrix is in a PDF format. So the senior currency strategist over at Standard Bank in London reminded me the other day that Eurozone countries tend to front-load their debt issuance so that in case there are hiccups in the year, they've got their funding. Any time that a country or countries will be unable to fund themselves will raise red flags for global investors who will be quick to sell euros. Standard is one of many banks looking for a lower euro in 2011, and they have a 6-month forecast of 120, a 1-year forecast of 110, and a 2-year forecast of 140. If you want to see any other forecasts, let Lauren know, and we can send over the piece I did Friday that goes into more details of the peripheral debt issuance and also has a few more bank forecasts. One bank in particular, Goldman Sachs, has a 12-month euro forecast of 150, and they see the peripheral funding going smoothly, which will catch euro bears off guard. In closing, I want to remind that we've been myopically focused lately on the Fed and the Eurozone peripherals, and there is a whole host of other items that may show up on the radar screen next year. I just wanted to briefly touch on a couple things that may come up. Look at the next slide. Here are some other what I call FX wildcards for next year. We have China. We're still waiting for the U.S. FX report, and as far as my D.C. knows, there's no new news there about when it's supposed to come out. Analysts don't think that the Treasury Department will name China as an FX manipulator, but if the U.S. job situation worsens, then more protectionist measures could pop up. On the Fed, we just had a monetary policy decision today, and no new news from the Fed, although yields have been rising, sharply rising. Going forward, the dollar will be driven by interest rate differentials and also by sentiment. If U.S. data disappoints and the market thinks there could be additional Fed purchases, the dollar will suffer, and vice versa. If the data is strong, like on a day today when we had strong retail sales, rising U.S. yields should underpin the dollar. But the problem then comes if we see that yields are rising globally, the dollar may not get the same bang for its buck. One other thing is commodities, and I'll put emerging markets in this category as well. There's some thinking that, commodities and EM have outperformed in 2010. The thinking is that if next year the developed economies bounce back, it may be better to be long U.S. or UK equities or other instruments that could perform next year. If this is true, we may see the EM instruments and EM currencies under pressure and commodities as well, and you could see the dollar and U.S. stocks firm. But other analysts telling me that mutual funds, sovereign wealth funds, and pension funds are still underallocated to both the emerging market sector and commodities, and that these institutions will use any sell-off in prices to gradually add to positions. Fiscal situation, it's still an ever-unfolding mystery, and can the U.S. get a responsible fiscal plan? We'll stay tuned for that. The last thing I was going to mention is just the currency diversification. Global central banks and sovereign wealth funds are still sitting loaded up long dollars, and right now they may be reluctant to add to their euro holdings in the short term while there's uncertainty about how the peripheral situation will unfold next year. But if indeed peripherals do manage to raise money uneventfully in the first quarter, the first half, the euro could see newfound demand from these sources, especially those central banks who've been actively buying dollars in 2010 to prevent their currencies from rising. If there's any questions, I'll let Lauren explain to you how you can ask a question.
Okay, either use the Q&A box that's at the bottom right-hand corner of your screen, or you can address Vicki directly in the box, and you can use the drop menu to choose your name. A to see if we have any questions. Okay, we have any questions. So if you join our January 2011 upcoming webinar, it'll be on January 26th at 4 p.m. presented by Heather Scott, who is our Washington Deputy Bureau Chief of International News, and she'll be presenting Latin America, A New Era. You can register either by emailing me, lhand@marketnews.com, or by visiting https://marketnews.webex.com, and you'll find the registration link there. If you'd like to contact Vicki directly, email is up on the screen, as our 100 number, our number, website, and you can follow us on Twitter and on Facebook. If you have to receive a copy of the PowerPoint presentation that we used today, you can email either myself or Vicki. It's lhand@marketnews.com or bsher@marketnews.com. And the recording of this presentation will be available by replay as well. I hope you have a presentation, and thank you very much.